Welcome to LR Reports. This channel focuses on institutional research that I've personally reviewed. As a fund manager and family office analyst, my role is to filter through a large volume of research and focus only on what truly matters. AI helps structure and deliver the content efficiently, but the selection and interpretation are human.
Welcome to The Critique. Today we're analyzing a piece of institutional research from HSBC Bank Middle East DFC.
The report is titled Investor Allocations Equity Strategy Global. Amid strong flows momentum, signs of peaking buy-side sentiment.
And it was published on January 7th, 2026.
This one really digs into the critical pivot point markets are facing after a pretty remarkable 2025.
Remarkable is one word for it.
Global equities had a massive year. Returns topped 21%.
Which makes it the third straight year of double-digit growth.
Exactly. And this was really fueled by exceptionally strong flow momentum. We're talking about $903 billion in global equity fund inflows.
Which works out to, 4.2% of total assets under management. A huge number.
The highest since 2021. And European equities in particular were leading the charge. But that's the backward-looking part. The real tension the report brings up, and I think this is the core of it, is that this strong history is masking what's coming next.
Right. It's pointing to these early signs of cooling optimism from the buy side.
And not just cooling optimism, real structural constraints on where future capital can even come from.
Okay, so that framework is pretty well set up. It creates that necessary tension between past performance and future risk.
It does. But to really maximize the impact of that pivot point, the report, it needs to resequence things a bit to make sure the biggest warning signals land with, maximum clarity for an institutional reader.
I think I see what you're getting at. The goal is to signal a change in the market regime, but the way the sentiment shift is presented it undermines its own urgency.
Precisely. The most important point that the buy-side sentiment indicator, the BSSI, saw a marginal decline. It's immediately undermined by the inclusion of all these counterbalancing variables.
So let's break that down. They introduced their proprietary indicator, the BSSI, which measures institutional risk tolerance.
And it just recently hit its highest level ever since 2014, 2.33.
A record high. But the key is that it's now retreated just slightly to 2.23.
And they frame that as the first cautious turn after 4 straight months of increases.
But here's the structural issue you're pointing to. The breakdown of what caused that decline immediately gets complicated.
Right. They list the 3 main drivers pushing the BSI lower: a fall in cyclical versus defensive allocations,
A decline in global equity fund flows,
and a drop in equity allocation within multi-asset funds. All very clear, cautious signals.
all strong signals. But then, almost on the same breath, the report says that the main thing that stopped the index from actually showing a sharper rise in risk appetite was this huge decline in money market fund flows.
And that just muddies the water. By instantly introducing a mitigating factor that was pulling in the opposite direction, the reader's first takeaway is, confusion.
That's a fair point. Instead of focusing on the clear signal, which is that institutional behavior turned cautious, the focus shifts to how hard it is to interpret the final number. It just softens the whole peaking optimism thesis.
So the suggestion here is all about resequencing. The BSSI analysis needs a much sharper, more focused narrative. That initial drop has to stand on its own as the headline warning.
Establish the negative inputs first.
Yes, cement the idea of a cautious turn in investor behavior with those 3 drivers.
And then you could separate the flow dynamics into a second distinct argument.
Exactly. You get the warning out first. Then you can have a separate section, call it mitigating factors or the flow drag, whatever.
That allows the report to be intellectually honest about the data.
Right. Acknowledging that broader flow softened the negative read.
Without blurring the core analytical signal right at the start.
And you could kick off that second section with a really sharp topic sentence, something like, the overall sentiment correction was mitigated by significant counterflow dynamics.
I like that. That keeps the focus where it should be, on the fact that equity managers themselves are showing stress at the margin, regardless of what's happening in money markets.
It sharpens the editorial angle immensely. Okay, so if we fix that narrative flow, we still have another problem, a mechanical one.
The market needing fuel.
Right. How does the report handle the capital deployment side of this equation?
This leads to what is, I think, probably the most significant structural constraint in the whole report. The fact that the huge fund flows in 2025 were heavily supported by funds just drawing down their cash.
And this section feels a little too descriptive right now.
I think its gravity is being undersold.
The data point itself is incredibly potent. Global equity funds managing $16 trillion in AUM saw their cash holdings fall by about 40 basis points in just the last 6 months.
To be clear, that's almost 0.5% of total fund assets being forced back into the market in a very short time.
And this massive drawdown has pushed cash levels down to just 0.6%. That's near the pre-pandemic low we last saw in early 2019.
So the structural constraint here, that multi-year low in cash, needs to be elevated. It's not just a data point. It's the primary macro headwind limiting any future flow.
The report says the scope to maintain the pace of cash unwinding is substantially limited.
Which, as you said, is almost an understatement. If your main source of internal capital, that cash buffer, is basically gone at 0.6%,
Then the primary engine that drove 2025's rally is, for all intents and purposes, shut down.
precisely. We have to quantify that historical significance and make the implication crystal clear. We need more assertive language. Funds are running on fumes. That 0.6% level is the market emptying its internal reserves.
So instead of saying the scoop to maintain the pace is limited, you'd suggest something more direct.
Much more direct, something like, future flow momentum is now entirely reliant on new external capital injection as internal cash buffers, the primary fuel for 2025's rally, are exhausted at multi-year lows of 0.6%.
That's powerful. It elevates that number into a central pillar of the whole forward-looking thesis.
You could even structurally place this entire cash constraint section before the BSSI discussion.
So you ground the sentiment analysis in a tangible mechanical scarcity of capital first.
Yes, it helps explain why managers are starting to feel constrained even before you look at their psychological outlook. It's a compelling mechanical reason for a slowdown.
Excellent. Okay, so let's pivot from the macro constraints to the specific institutional positioning. This is where we see current preferences.
Right, they use Z-scores to compare current active weightings to the 5-year history.
And globally, Japan comes out as the most overweight region, while Switzerland is the most underweight.
And sector-wise?
Healthcare and industrials are the most overweight sectors globally. On the other side, financials and energy are the most underweight.
And that context of positioning leads us right into what I think is the most compelling tactical idea in the whole piece.
The divergence in European sectors.
Specifically, what's happening in information technology.
The data is stark. European funds cut their IT exposure by 26 basis points in just the last 3 months. That's the biggest reduction of any European sector.
And they're not hiding the reason. It's concerns about a potential AI bubble and just general uncertainty about profit growth.
This aggressive selling has pushed their holdings to more than 2 standard deviations below the 5-year average.
That is some seriously depressed positioning. I mean, to put it simply, managers are more underweight tech now than they've been for almost the entire last 5 years.
And yet, the report then frames this as a significant opportunity.
Which rests on 2 key facts. First, consensus sell-side EPS growth for the sector is still a pretty robust 11% for 2026.
And second, the sector actually got a little cheaper last year. The forward PE derated by 1.3%.
And that's where the vulnerability in the argument is. To really maximize conviction in this contrarian IT call, the analysis needs to more systematically refute the buy-side's fears, especially that AI bubble narrative.
You're saying the weakness is that it presents the opportunity, the depressed positioning and the positive EPS, without really bridging the gap. It doesn't neutralize the powerful fear that drove the sell-off in the first place.
A bubble narrative is a strong driver. You have to tackle it head-on. The suggestion is to turn the existing facts into tools for neutralization. You have to explicitly connect the D-rating to the positioning.
So instead of just listing the data points, you use them to argue that the risk has already been priced in by the sell-off itself.
Exactly. A concrete example of that reframing would be a statement like this. The 1.3% PED rating confirms the market has already priced in substantial skepticism about the AI narrative.
And if the consensus 11% EPS growth holds, the current aggressive underweight positioning represents a significant low-risk entry point.
A low-risk entry point that inherently manages those initial bubble concerns.
That's a vital reframing. It turns the source of the fear into a measure of the opportunity. It makes the contrarian call much more robust for a skeptical institution.
Right. Now let's contrast that speculative IT opportunity with the other key area of conviction in Europe.
Financials. This is the non-contrarian part of the strategy.
The robust pillar.
The report notes financials was the top-performing sector in 2025, up 50% versus the benchmark. And funds added 42 basis points to their allocation last year.
But here's the key finding. Even after that huge run, active positioning is still just average, close to the long-term Z-score.
Which is unusual. Normally, after a 50% run, positioning is at an extreme.
The fact that it's only at average levels suggests there's a lot of conviction that the fundamental drivers are sustainable. There's still a margin for more buying.
And the report points to two drivers for that. First, the sector is well-positioned for a pause and central bank rate cuts.
Which removes that immediate headwind while keeping margins healthy.
And second, sell-side EPS estimate momentum for financials is among the highest in the entire region.
See, that's what makes the overall European call so compelling. Unlike IT, which relies on analysts being right and managers capitulating, the financials thesis is structurally sound.
So it's a defensive complement to the aggressive IT call.
Exactly. Okay, so let's pull all these threads together into the main risks and constraints. We've basically moved from an internally funded market to an externally dependent one.
Right. The structural constraint of exhausted cash at 0.6% means any new momentum has to come from new external capital. That is a clear regime shift from 2025.
Then you have the sentiment risk. The BSSI indicator at 2.23 is near the high end of its historical range.
So historically high sentiment implies a risk of mean reversion, which could limit upside.
And finally, the tactical risk is all centered on that European tech divergence.
Will the buy-side's fear about a bubble prove right, justifying their extreme underweight?
Or will the sell side's robust 11% earnings forecast hold up, forcing funds to capitulate and buy back in from these depressed levels?
That seems to capture the full scope. The original document has all the right data, but by tweaking the editorial flow and the language, you can really sharpen the signal that a regime change is happening.
Precisely. The goal here should be to communicate very clearly that the easy phase of capital deployment is over. Returns from here on are going to depend on high-conviction, very specific positioning calls.
So, to recap our actionable suggestions for improving the report's impact. First, sharpen the BSSI narrative. Separate the drivers of the decline from the mitigating flow factors.
Don't let the peaking optimism thesis get diluted. Second, elevate that 0.6% cash constraint to the primary structural headwind. Use strong language to emphasize that the internal flow engine is exhausted.
And third, fortify the contrarian European IT call. Systematically link the derating and the aggressive underweight positioning to directly refute the buy-side's fears about an AI bubble.
Make the opportunity feel like a calculated risk, not just a bet on mean reversion.
This concludes the institutional research briefing. This analysis was based on data provided by Morningstar, FTSE Russell, FactSet, and HSBC calculations.
We invite the listener to refine this material and submit it back in for a further critique.
That's how we approach research internally. Filter first, then analyze, and only then decide what's worth sharing. If you find this useful, feel free to follow the channel. I'll see you in the next episode.